In this video, we're going to be performing a deep dive on Chevron's dividend safety. To begin, let's talk about Chevron's business model. Chevron is the third largest oil major in the world based on its market capitalization of $230 billion, behind only Shell and ExxonMobil. When oil was trading around $100, Chevron generated about 90% of its earnings from its upstream segment. Lower oil prices have hurt the upstream segment and greatly improved refining segment margins. In 2017, Chevron generated 61% of its earnings from its upstream segment and 39% from its downstream segment. While ExxonMobil, BP, and Total produce crude oil and natural gas at approximately equal ratios, Chevron is more leveraged to the oil price, with a 57-43 production ratio. Chevron is a well-known dividend stock because of its compelling track record of dividend growth. With 32 years of consecutive dividend increases, Chevron is a member of the Dividend Aristocrats Index, a group of elite dividend stocks with more than 25 years of consecutive dividend increases. Chevron also trades with a very high yield. This combination of high yield, dividend growth, and overall business leadership causes Chevron to be categorized as a blue-chip stock by many retail investors. Looking ahead, Chevron's high dividend yield combined with volatility in the price of crude oil has led many investors to question the safety of its future dividend payments. For the remainder of this video, we will discuss the company's current dividend safety from four perspectives: its dividend safety in the context of its current earnings, its dividend safety in the context of its current free cash flow, its dividend safety in the context of its recession performance, and its dividend safety in the context of its current debt load. First, let's discuss Chevron's dividend safety in the context of the company's current earnings. Through the first 9 months of fiscal 2018, Chevron has generated earnings per share of $5.79. We believe that the company is capable of delivering full-year earnings per share of about $8. For context, Chevron currently pays a quarterly dividend of $1.12 per share, which implies a payout ratio of just 56%. Using earnings, Chevron's dividend appears very safe for the foreseeable future. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. Accordingly, we will now compare Chevron's current dividend payment to its free cash flow. Through the first 9 months of fiscal 2018, Chevron generated $21.5 billion of cash from operating activities and spent $9.8 billion on capital expenditures for free cash flow of $21.7 billion. At the same time, Chevron paid $6.4 billion in common share dividends for a free cash flow dividend payout ratio of just 29%. Using free cash flow, our conclusion is the same. Chevron's dividend appears safe for the foreseeable future, and its payout ratio using free cash flow is actually lower than the earnings per share equivalent. Companies do not cut their dividends in the good times. Instead, dividends are reduced when companies experience financial difficulties. Accordingly, this section will analyze Chevron's current dividend safety in the context of the company's historical recession performance. We believe that the best way to measure a company's recession resiliency is by measuring its earnings per share performance during the financial crisis that occurred between 2007 and 2009. Chevron's performance during this time period is shown here. Chevron's earnings per share were characteristically volatile during the last recession. Importantly, though, they covered its dividend payment during each year of the economic contraction. What is perhaps more important is Chevron's performance during the decline in oil prices that began in 2014. The company's performance during this time period is shown here. As you can see, Chevron's earnings dropped off a cliff during the oil price decline that began in 2014. Moreover, the company's earnings did not cover its dividend during either 2015, 2016, or 2017. For investors, the main takeaway here is that Chevron's earnings tend to perform well during broad economic contractions, but declines in the price of crude oil materially affect its earnings power and potentially the safety of its dividend. The last angle that we will use to assess Chevron's current dividend safety is by looking at the company's current debt level. More specifically, we will see how much the company's weighted average interest rate will need to increase before the company's adjusted net income will no longer cover its dividend payment. In fiscal 2017, Chevron generated $902 million of interest expense and had $33.5 billion of total debt for a weighted average interest rate of 2.7%. The following image shows how changes to Chevron's weighted average interest rate would impact the company's dividend coverage as measured by free cash flow. As the image shows, Chevron's weighted average interest rate would need to rise above the 20% level before its dividend would no longer be covered by free cash flow. Accordingly, we believe that Chevron's debt level is unlikely to impact the safety of its dividend moving forward. Thank you for watching today's video, which performed a deep dive on Chevron's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover Share Dividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website at www.sharedividend.com.